What's up everybody? Welcome to the Stocks channel. My name is Cory, and today in the stock market, the bulls tried to break out after the CPI data, but again, the big bad bear continues to reject the price action. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so today SPY was up 0.76% after a very large pre-market gap up that brought us all the way above the bear market resistance trendline. But we quickly saw sellers stepping back into the market because that is exactly where the big bad bear is waiting. So we don't typically talk about fundamentals on this channel, but it is important to know that while CPI data is showing signs of rolling over and coming down, inflation is still far too high and the market is still very concerned about a hawkish Fed that is trying to drive the market through a recession, and the stock market has likely not yet priced in that recession. So for that reason, do not expect this big bad bear to go away. We are going to need the bulls to prove it. There is nothing wrong with getting bullish above support, but you instantly need to manage your risk if support is lost because we are very likely still in a bear market while SPY is below this bear market resistance trend line. If you zoom out and we start to see SPY breaking and closing above SPY 414 and building a bull trend, then we can instantly start thinking something else is happening in this market. But for all we know right now, this is still a bear market and we continue to see rejections from that bear market resistance trend line. Now also keep in mind the 200 daily simple moving average is still a negative slope and SPY is trying to find support at that level. So if we do start to find support around this zone, turn around and get that bull breakout of confirmation after FOMC and continue higher into next week, then we are very likely starting somewhat of a bull trend that could be sustainable. There's other reasons why I don't think that's what's happening, but one of them is simply the relative weakness that we're seeing in the Nasdaq 100, which is currently still underperforming the Dow Jones and the S&P 500, and I can't think of any sustainable bull rallies that are going to last while the tech sector is still getting beaten up. You could look at the ARK ETFs and the triple Qs, and they're still relatively underperforming, and that is not bull market behavior. So yes, I think the bear is still alive and well, and I'm going to wait until the price action proves otherwise because this is still a bear market while price action is below these resistance levels. So going into FOMC tomorrow, expect another very volatile day, and yes, it will be on very high volume. But again, if you draw a horizontal line from the price close today, we have still gone absolutely nowhere for an entire month. I keep telling you we've gone nowhere for a month because I do believe the next breakout is going to have plenty of meat left on the bone, and there is no reason for you to get chopped up in this consolidation range of going sideways. Just wait for the confirmation in a breakout. The breakout is going to be SPY starting to close above 408, or the bear breakdown will be the closes below 393. Between SPY 393 and 408 is going to be the chop zone of that consolidation period, and you are going to get eaten alive if you continue to expect a breakout without any confirmation. So this morning gap up was clearly a false breakout because we were above 408 intraday in the morning, but we instantly lost that support at the breakout, which should have been that level at 408, and came all the way back down to SPY 402. So we need the daily closes above 408 or the daily closes below 393 to get confirmation that we're breaking out of this monthly sideways consolidation. Again, we had very high volume today, so there's definitely some positions starting to move around that should break us out of this consolidation. And we do have the daily Bollinger Band squeeze, which is likely going to trigger us into the next leg higher or the next leg lower. So look for that Bollinger Band squeeze to fire soon once we get the confirmation of the breakout in the price action. Other support levels to consider will be the 200 simple moving average at 402.5 and this support zone between 399 and 400, which is also the rising 20 daily simple moving average. On the Nasdaq 100 triple Qs, we were up 1.08%, and intraday we had that huge gap up plus 4% morning where we opened up around 297 and instantly found the big bad bear waiting at that level outside the upper Bollinger Band and drove us all the way back down towards this support zone around 288. We still have a pre-market gap that doesn't fill until we get back down a little bit lower around 285.7. So keep that in mind that that gap did not fill from the pre-market gap up. Now the critical resistance the bulls need to break and close above on daily levels is going to be this level right around 293, and the bears need to get the breakdown below 280. Remember, we still have this valid double bottom price target at 308, which is the gap close, as long as the triple Qs are above the neckline breakout at 284, and we are still currently above that neckline breakout. So there is still a bullish scenario where the triple Qs run up to fill the gap at 308, or at a very minimum, at least test the negatively sloping 200 daily moving average around 303. So even in a bear market scenario, there is still the possibility the triple Qs need to go higher before they go any lower. So don't get overly biased. If we do get the bull breakout above 293 on the triple Qs, that is bullish no matter how you look at it. It could be a short-lived lower high and a rejection from the negatively sloping 200 daily moving average, but in the short term, it is still possible that we can go higher. Just to put this in perspective, we could go hit that price target, close the gap, and still get a bear market rejection from that level, and then come down to fill the gap at 268. So have an open mind and let the chart do all of the talking, and that's the definition of following price action and being objective. So the critical resistance remains at 293 and the critical support remains at 280, and also pay attention to that neckline breakout for the double bottom at 284. On the Dow Jones, we were up 0.35%, and clearly we did not go down and fill the gap after CPI data at 331, but we did get another daily rejection from the resistance, and the gap is now closed at that level at 347. So there is still the possibility of a rejection from that level and coming down to fill the gap at a later date. However, while we are above a rising 20-day simple moving average, it is very unlikely we are getting the bear scenario, so you may want to wait for confirmation of the breakdown below this support at 340. Below 340, we could retest the lows around 335, and then below that, we should easily fill the gap at 331. But for the time being, based on the fact that the price action is above a rising 20 daily simple moving average, we're going to delete that arrow because I don't want you just looking at the arrow assuming we have to go lower. Right now, the chart is saying we could go higher before we go any lower. Watch that critical resistance zone around 342 and 347, and if we do get the bull breakout, the next resistance will be up there at 353. On the Russell 2000 IWM ETF, we were up 0.37% today, and again, we had a bull breakout pre-market at the gap up, and then we instantly saw sellers above that level, and then we did close back down below the negatively sloping 200 daily simple moving average and negatively sloping 20 daily moving average. Now we did close just above the 50 EMA, but we still do have a valid double top price target down here right around 176 while we're below this neckline at 182, and we did close below 182. So it does look like the small caps still have more downside to go to hit that price target while we're below this neckline at 182, and we will need to get the bull breakout above 184 to start looking more bullish. So again, the bears are still alive and well, and they are still selling at all of this critical resistance level, so do pay attention to the price action and make sure you're not getting fooled by the daily closes, because it's not until the candle closes that we count the price action, and right now the price action is still closing below the double top neckline. On the ARKK ETF, we were down 0.06%, and just pay attention to how bearish we had the rejection on the ARK ETF, where we had a gap up open that was over 8%, and we gave it all back and closed in the red below a negatively sloping 50 EMA and negatively sloping 20 daily moving average. That is extremely bearish price action, giving back over 8% of profits just in one swift trading day, so it is very clear that the ARK ETF is still in a very strong bear market, finding plenty of sellers around that resistance at 38. For that reason, you can't get bullish until we close above 38, so continue to respect that very strong resistance. On a break below 34, we will be looking for a retest of the 52-week lows at 32.5, and then the next leg lower will be 31.3 and $30. On the VIX, we were down 9.8% today, and we did see the VIX closing back down below 24, but overall the VIX is still above the 20 daily moving average, and so far, for all we know, the VIX is only trying to put in a higher low. So this is going to remain a very volatile market while the VIX is above 20, and it's not until the VIX starts getting consecutive closes below 20 that we could say that a bull market is returning. On Bitcoin, we're currently up 3.28% as Bitcoin is getting that bull breakout above that critical resistance at 17,550, which means above this level, we could very likely run up to the next resistance at 19,000. Look for potential support now at 17,550 to confirm the breakout, and you can stay bullish above this support level. On Amazon stock, we were up 2.14% today, and Amazon failed to close above the 20 daily moving average, and we are still closing below a negatively sloping 20 daily moving average, which does confirm we could still be heading lower. We're going to get a lot more bullish if we could start breaking above 97 and 102, and then we will have the gap fill at 110. But for the time being, this is still looking like lower highs and lower lows, which means we could be coming back down to retest the 52-week low at 86. Below 86, we could go for the next leg lower at 77, but we can't rule out the potential of a double bottom right off that level at 86. On Microsoft stock, we were up 1.75% today, and Microsoft also had a very bullish gap up open way outside the upper Bollinger Band on the daily chart and hit the negatively sloping 200 daily simple moving average and found resistance at that level. We failed to fully close the gap at 265 because we found resistance at the 200 daily moving average, and we still have an open gap to the downside right around 252.7. So as a bull, you'll want to use support around 255 to 252 because as long as we're above that level, you can stay bullish for the gap close above at 265 and that resistance around 268. If we lose support at 252, we could be coming back down to 244 to 242. And if we lose all of that support, we will be looking for the bears to fill the gap at 228. On Nvidia stock, we were up 3.06% today, and we did see the bull breakout above the resistance trend line that defines the bear market and the negatively sloping 200 daily moving average at 175. We still have a gap to fill to the downside around 175.6, and we also have that gap down there at 142. So if this is a false breakout, we should see very quickly, and we should see a very sharp sell-off to the downside back down towards 156. However, if the bulls can hold the breakout and hold the support zone around 166, we could get another bounce and start seeing Nvidia running up into the 190s and 200s. So for the time being, manage your risk as bulls around 175 to 166, and if you are bearish, you now need to move your risk level all the way up there to 192. On Tesla stock, we were down 4.09% as Tesla continues to underperform, and we are getting that retail capitulation that we were speculating about because this is a retail favorite stock that is now breaking down to brand new 52-week lows. We saw Tesla closing down below 167, which means it did confirm the double top, and the double top price target is all the way down here at 138. On the way to the price target, we could find support around 155, so do keep that in mind. And you'll now want to manage your risk as bears right around this neckline at 167 all the way up to about 173. Price actions below all the moving averages, so this is a very strong bear trend. And we still do have much lower prices to go if we are getting the double top price target. Critical upside resistance will be this level right around 167 to 173 all the way up to the 20 daily moving average around 180. On Apple stock, we were up 0.68% and Apple tried to get the bull breakout above 146, but clearly there were plenty of sellers around 150 to drive Apple all the way back down below the bear market resistance trendline, so Apple is still closing below the critical resistance. You could get more bullish if we start getting daily closes above 146 and 150, but for the time being, it still looks like the bears are showing up at resistance, and we still have open gaps to fill to the downside at 138 and 133. The financials were up 0.26% today, trying to gap up above resistance, but getting rejected, and we still do have the gap to fill to the downside at 34.35. The industrials were up 0.38% today with the price action back above all of the moving averages, and we still have the bull trend, so the industrials could be getting ready to roll from here. The healthcare sector was up 0.31%, continuing to look bullish with the price action above all the moving averages, and we still have a very strong bull trend. The energy sector was up 1.9% today, confirming that bounce from that support around 84, but finding resistance right below the 50 EMA. So we got the bounce we were looking for in the short term, and it is now possible we could get rejected and continue lower down towards the rising 200 daily moving average, which is right around $80. So jumping back over to the S&P 500, today was a very exciting day with plenty of volatility, but we still have no clear direction because we are still in this sideways consolidation going back 1 month with no clear breakout. FOMC is tomorrow, so we could get plenty of more volatility, but we're not going to be sure where the market wants to go until we get confirmation in the price action and break out of this consolidation. So know that critical resistance at SPY 408 and that critical support at 393. And once we get the confirmation of the breakout, there's going to be plenty of room left in the market to catch that trade, knowing you're going to be on the right side of the trade. So try not to get overly chopped up during this consolidation phase. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. If you want to learn more about Bank or want to learn how to subscribe, you can click on the link in the description of this video. If you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.